Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Kate Campbell, it's always a pleasure to have you with me on the Australian Finance Podcast. How are you going?
I am very good, Owen, and it's good to be back talking about everyone's favourite Australian topic.
Yes, which is property. So whether you're a new buyer of property, whether you're an investor, whether you're a homeowner, just looking and thinking about interest rates and all these types of things, this is the episode for you. And we're bringing to you two experts. So Kate and I are going to take a bit of a backwards step here and just watch on as these two experts just riff on property. We've asked them to bring 5 tips to the show today. So we're joined by Chris Bates from Wealthful. Chris, how you going, mate?
Awesome to be here, Owen and Kate. Good to see you both.
Likewise. Listeners, you will remember Chris because he's done the property course with us. He's also been on the show quite a few times, has his own podcast that he runs and a business, mortgage broker from Sydney. Look him up. And we're joined by Emily Wallace. Emily, welcome to the show. Your first time with us. Tell us a little bit about yourself.
It is indeed. Thanks for having me on board. So I'm a Melbourne-based buyer's advocate, helping first and family home buyers into the market. Love all things property, a bit obsessed with it. And when I'm not buying property, I'm scrolling other properties on Airbnb.
Yep, it's one of those things where people just love to do it. Domain and realestate.com.au, 2 of the most popular websites in Australia. We have this affinity across the country. So wonderful. Okay, if you want to learn more about what Emily or what Chris do, you can find all the links in the show notes. So those will be there for you, and feel free to jump into the Facebook community and have a chat there. Kate, what are we thinking? Maybe we'll go Emily goes, Chris goes type thing?
Yeah, absolutely. And I think it's a little bit more interesting for me today than our property episodes in the past because I'm actually contemplating purchasing a property this year.
Oh.
Although I was thinking the other day that I wish there was a service I could just magically say, can you just make a property appear and I will just pay the money and you can do all the paperwork and everything. But I do believe you do have to do a little bit of work, even if you use services like Emily and Chris, and you do need to educate yourself a little bit. And so I'm looking forward to today's episode.
Yes. Why don't we go ladies first? So Emily, what's your number one tip for people that are looking at the property market in 2022?
Definitely. So one of the biggest things we come up against is obviously the barrier to entry into the market being saving a deposit. So one of my tips would be to understand the guarantor loan options. If it's suitable for you, obviously a broker would be able to talk through in more extent as to the suitability and options with that. But a lot of people, I'm often baffled by how many people don't understand a guarantor loan and how it actually can be beneficial to fast tracking their property journey. So if you're thinking the clock's ticking in 2022 to get into the market, I would strongly encourage you to educate yourself and understand what a guarantor loan can assist you with.
Yeah, sure. I think Chris, being a mortgage broker, might be able to lend a bit of advice here or a bit of wisdom. So Chris, what is it?
Yeah, thanks. That's actually what I should put that as one of my tips, actually. I'd say it's guarantor loan and lender's mortgage insurance. I'd say they're both tools that you should consider if you're a first home buyer. Sometimes people think I've got to have a 20% deposit and they don't understand how LMI works and how it gets more expensive as a percentage, what you borrow and what it even is. Some people think it's a flat fee or an annual fee, etc. So get understanding of LMI, how it works. To give you a little quick tip, probably around an 88% loan or a 90% loan is what you should really aim for as a minimum. So a 10 or a 12% deposit. But if you're talking Melbourne or Sydney or Brisbane, even after the last 12 months, you're talking a lot of deposit when you add also stamp duty on top. So you could be talking 15 or 17% times the purchase price. A lot of money, right? 150, 200 grand sort of thing. So Emily's absolutely right. I mean, not everyone has got the benefit of having usually parents that are in a financial position to give you a guarantor. You know, they may not own a property, or maybe they've got a house and it's got a lot of debt on it, or, maybe maybe they've got a home, they're not looking to sell or downsize. you haven't got a family of 10 kids, you've only got one brother or sister, and that can be an issue when multiple kids want to use it at the same time, and family Christmas party antics. So there's things that we can really understand guarantors. If your parents are in the position to do it, and it's not going to affect them, and your brothers and sisters are okay with it, then it can be a huge benefit for you, because basically you don't need a deposit. You'd still want to use your money in offset accounts and things like that, but you don't need to find this deposit. You don't need to pay a big lender's mortgage insurance, and it doesn't really cost your parents anything ongoing. You pay all the mortgage. And you can the biggest thing and mistake people make with a guarantor loan is they buy a poor quality asset. So they go to mum and dad, I'm going to use your equity in your place to protect myself, and so I don't need to pay lender's mortgage insurance. And then they go buy an off the plan apartment, or they go and buy an investment property in a regional town and just hope for the best. So you've got to buy a quality asset. And you've got to think through how to best protect your family. Big caveat, though, I don't want to go on about this forever, but big caveat with guarantor loans is you've got to take a personal responsibility that your parents are doing you a favor, and you've got to try to get rid of it. And so I would say, within 3 to 5 years, you've got to come to them with a plan prior to asking, like, this is how it works. This is the type of quality property I'm going to get, and this is how I'm going to get rid of it. Do that research first before you have a conversation with your parents about it, because that's what they really care about is you taking action once they help you.
Chris, does it have to be your parents, or can Owen guarantee my home loan?
Absolutely. If you've got an older brother or sister or family or friends or could do it, I would say that 99% of the time it's the parents, because a lot of the brothers and sisters either want to use that equity for themselves because they want to upgrade or have investments, etc. So parents are usually the ones who do it.
Yeah. And I think that's a really good point you make there about making sure you go to your parents, assuming it's your parents, prepared, because they want to know that you have the confidence that what it is, how it's going to work and how they're going to get off it, because they might, typically parents might want to retire in 5 years and they might want to liquidate their home or downsize, and they've secured against their property too. So great point there. So what was your number one then, Chris? That was a great intro from Emily. What would be your number one tip?
Look, I would say right now it's, we've had a big boom in 2021, 2022. There's lots of fear around rising interest rates, and the media are going to start playing on this a lot. You've already seen all the banks come out with big forecasts on property price falls. You've had, respected commentators like Chris Joy call for 4 big falls. And so there's a bit of a media spin's gone from boom to bust. And you just got to be really careful that the type of property that you're buying and understanding that it's micro markets. And even though the Australian property market probably does have a lot of headwinds coming up with higher interest rates, that doesn't mean that the type of property that you want and the right type of property for you longer term is going to fall in value. And what downturns have shown us in the past, like 2018, the 2003, etc., is it's actually harder to buy quality assets and good property when markets go down, because good property people don't sell, and so liquidity drives up. So don't fall for this big media storm that all properties are going to fall by 15-20% next year, because it actually probably won't happen. You'll find good properties hold their value, and poorer properties, things that are compromised, will lose a lot more value. And that's if that even happens at all. You could find there's more stimulus and things don't even happen like that. So be careful with the media storm talking about the big market, and focus on your micro market and the type of property you want, and understanding the quality of that.
I remember during COVID, Chris, CBA, I don't know if the media just took this out of context, but the CBA had a forecast of 32% fall in house prices, and they basically went exactly in the opposite direction over the next 12 months. So be very careful with that. Kate, Emily's got a tip, and I reckon it would help you out right now. Just, speaking on your behalf. Emily, what's number 2 for you?
So we're looking at renting before you buy as a tip to be familiar with a new area. So it's not uncommon that you've grown up in a certain area, you've fled the nest from mum and dad, or you've gone and rented somewhere with a friend, but now it's time to buy, and looking at your budget and what that affords you might be in an area that you've never lived in before. So one of the biggest tips would be renting in the area you intend to purchase in before committing to a purchase. And this largely comes off the back of 2020 and 2021, when so many people made a sea change to an area that they maybe visited for a weekend at best. And interestingly enough, I think this is a trend to keep an eye out for. Very much a side note here, but I suspect that there will be people who haven't adapted to those areas as well as they thought they would because they were not informed or they hadn't lived there before. And we start seeing them flock back from the regions into the city. So renting before you buy in an area is crucial because you've got a well-rounded opinion of the area. Also, Facebook groups of areas are really good. I often stalk community Facebook groups to get intel on, what's happening in certain streets of a suburb. But really, ultimately, if you could afford to rent even a 6-month lease just to get a feel while you're looking, I think that would be a real advantage to you in making a very informed decision of your new suburb.
Got to make sure there's good coffee shops nearby.
Totally. Number one priority.
There you go,
It's
Kate.
actually
There's
a really
something for you.
good tip there, Emily.
It is.
I would say, because we obviously encourage that as well. If you're renting and you're thinking about moving to a new suburb, and sometimes buyers think they're going to perfectly time their lease finishing with their home purchase and their settlement date, and it's all just going to miraculously happen. The reality is, what I would probably suggest is break your lease, move to that area ASAP. And when you're looking at this property, just be living in that area and rent something out and go through the move, because I'd rather move to a rental and then move back to the city to another rental than move there and buy a property and then have to sell a property. And so if you're already in that position where you're looking in areas where you're not live and you can break your lease, take the cost on, get in there and start renting. Because it's you don't want to move to the area and then have to sell. Stamp duty, selling costs, it might not work very well, etc.
There you go, Kate. When you move to London, you can go and rent first, and then then you can buy.
Oh gosh, I don't know if buying in London's possible in one's lifetime anymore. But Chris, what's your second tip?
Look, I think you definitely need to think long term. I think there's, long term in terms of switching off from the media storm, obviously, but also thinking, how's your situation going to change long term? A lot of younger people want to live for the moment, maybe, and don't want to say what I'm going to be doing in 5 years. But I do think forward planning is essential with property decisions. Look, what's the likelihood of you going to live in that city longer term? What's going to happen if you meet someone? Are you going to want a family? And see if you can incorporate what you want from a long-term lifestyle point of view and making sure it's a great investment, rather than what my needs are today. Even today, we had a client trying to buy a 1-bedroom apartment in the inner east of Sydney. She can afford a 2-bed. Just by potentially taking a little bit more debt, not too much more, and it gives her that scope. If she does meet someone and she does want a kid in a few years' time, then she's got a perfect place for that, rather than a tiny little 1-bed that she'd outgrow. So think long term with all your decisions, and you're thinking through, if I make this move, how am I then going to make that next move? If I buy this investment property, how is that going to stop me upgrading my house, or how's that going to stop my renovation? So you've always got to be thinking long term, and try to switch off from the trying to play the market and et cetera like that, because quality assets, unfortunately, are even harder to buy in down markets, as I said before.
Yeah, it's a really good point, Chris. Emily, I had a friend this morning who was talking to me about buying a house, and he was saying in the suburb that he was looking in, he's been looking for about a year now, and he was saying that some of the houses in his area may have fallen for $50,000, slightly lower quality, but maybe $50,000 less than what he thought he would be purchasing, six months ago. So, and my point was basically, hey, well, maybe there's a reason for them selling. This is relating to your third point. I'd love for you to just dive into this.
In terms of if something's cheaper in the market or appearing.
Yeah.
Yeah.
And understanding why they're selling.
Yeah. So I guess, one of my key tips is around vendor motivation, and that can play into price. But what we're experiencing, and I think this is fair to say across the board, is a domino effect of stock holding. So what that means is a lot of people are hesitant to sell their property because they've got nowhere to go, right? We've got a stock shortage across the board, and therefore a vendor might not want to sell until they've found something. So when we're talking about vendor motivation, we need to understand, do they already have somewhere to go and they just need to get X amount? And that might be the case of your friend seeing something that is slightly below what they thought they'd need to pay, and maybe the vendor just needs to get out. Or is the vendor motivation that we actually need to know our sale price, to know what we can go and buy, and along with that, we're going to put a preference on someone who places an offer with a 120-day settlement, for example. So it's interesting when people, it's probably an agent's pet peeve when they go, oh, why is the vendor selling? Why are they selling? It actually doesn't really matter. What matters is what will the vendor take as a preference when I put forward my offer or when I put forward my terms. That's a better question, a better quality question to be asking the agent, to understand how you can make your offer most attractive to the vendor. You might even find that the vendor's got resistance because they don't want their property sold to a developer. They'd rather it go to a first home buyer. So putting a letter with your office explaining who you are and your intentions with the property, we've actually won properties for a lesser purchase price based off doing that very thing. So understanding the vendor's motivation, not just, why are they selling? It's a very basic question, a bit more of a understanding of their motivation is a good thing to know as a buyer.
Can I just ask one follow-up with an example here? Let's say you come across a house that you like. It's a bit older, it's a bit tired, but you've come across the house and you notice, that's a bit run down, and you think, okay, I'm going to ask them why they're selling. And you find out it's a retiree. They own the house and they're moving out. How would that inform someone? Like what would be going through your mind? Like, oh, so how do I now take that information and then roll that into something?
Definitely. So particularly in that situation, if they're downsizing from the family home, it's quite a sentimental property, but also their journey to downsizing could be quite a long one. So if I've got that information on hand, there's a couple of things I wanted to be across is, when do they intend to move out, whether that might be prior to settlement. If it's run down, can we actually get access to get trades to quote things that we can start getting the process underway to fix it up? B would be, if they're a bit hesitant to move and they really don't have anywhere to go, would we maybe look at renting the property back to them for a period of time so they're not feeling as pressured to move on? Whilst also trying to get access for those trades. That's the biggest thing, is to get in there and do the quotes. But certainly if it's been a family home, one that's been in the family for a long time and they're now downsizing, you often find it's a sentimental sale that's quite emotional. And so being aware of that as a buyer and being patient, but also if it's something you intend to sort of restore to its former glory, making that known to the seller.
Yeah, it's probably a very different mindset of the seller if it's someone that's lived in it for 20 years versus someone who's rented it the whole time and never actually lived in it personally. So they different emotional attachment during that process.
Very much so, yeah.
Yeah. Wonderful. Chris, what's your number 3 tip, mate?
Oh, awesome tip there, Emily. I think a lot of people think it's always down to price, but a lot of the time it is down to terms. And the lease back is definitely something that, in these markets, are very appealing to a lot of sellers because they may need that money. They need to sell the property. They put that money in the bank account and now they're ready to go and they can rent a place for maybe 6 or 12 months, depending on what you make on the terms. So it's a really good tip. I say Emily actually stole my thunder. So thanks for that, Emily. She mentioned it was be careful with the regions. And I do think this is a bit of a danger zone for a lot of people. There's obviously a lot of hype around the regions, and we've had lots of clients move to. There's 2 types of regions: the sister or brother of the capital city. The ones that are commutable within an hour or two, and people can do it on a weekly basis. And then you got the real pure regions that people aren't able to commute to the city. Both are a bit of a danger. Both of them have gone up a lot, and they're driven by 2 things: one, people moving there from capital cities, but B, low interest rates. So the internal demand has been pushed up because people are taking on more debt because rates are all-time low, but also demand's being pushed up by people moving there. Now, I do think that people are going to keep moving there. I do think, like Emily, people are going to start moving back. But a lot of the affordability segment of the regions is driven by interest rates. And a lot of investors and people are playing in this space, and prices have been pushed up a lot really fast. And it wouldn't take much for higher interest rates to really take back a bit of that growth. So if you are playing in the regional areas, you want to be playing in the aspirational part, which is where there's real scarcity, which is where the locals really would love to live and where the people doing well financially would love to live in those regions. And they're very small pockets of these regional towns. They're like a few streets or right near the water. And that's the place people are going to continue to move from the capital city for, because they're like, I left Sydney, but look what I got. Look what I got for my money. So the aspirational, the higher end of the regions, I'm a bit more confident on, but the affordability part, Also, because prices are higher, it's now less affordable. And so people are less likely to move to the regions. So it's got to be really careful with the regions. I think people are just hitting and hoping because they can't afford the capital city. And, could very easily see, higher interest rates put pressure on them. And then people come back to the city if the return to works aren't as favorable for their roles.
And that's probably where that rent before you buy tip comes in, because you might realize you really don't like the commute from Bendigo to Melbourne for your 2 days in the office a week.
Absolutely. And that's the thing, if you can rent in these regions first, that de-risks your personal sort of risk of going there and then having to come back and the financial cost of all that.
I think we're up to, Kate, are we up to number 4? We're getting through this list pretty quick.
Yeah, I think so. Emily's fourth suggestion.
So this one's a bit more of a philosophical one around mindset, because it's just so interesting, the psychology of not just the buyer themselves, but the people around them when they do go and purchase a property, particularly if maybe they're the first one in their friendship group to go and buy a property, or maybe the first in their family. Like if, you've got yourself and 3 siblings and you're the first one to go and make the move. It's interesting being an observer of this process. And what I often find, without even realizing it, sometimes the people closest to the buyer are deterring them from a purchase. They're quite negative, they're quite picky, and but it's in your best interest. I'm trying to point out things that you need to know about, which I believe there is a degree of that, and certainly a supporting role, mum and dad or brother, sister, friend to come along. But I think you also need to be aware that this is a very big step for you. To go and purchase a property is a milestone for anybody. And so when there is a milestone or a point of success, it can leave others around you feeling a little bit like they're not there yet, and feeling a bit deflated. So I think the buying mindset is just to be aware of other people and who you actually involve in the buying process. I know there's some buyers that we've worked with who haven't even told anyone that they're looking to purchase, because they just don't want to be influenced or have anyone in the process be across what they're doing. They just want to be independent and have a professional next to them and just trust in that process. But just, I think if you are thinking of buying this year or any year really, just be careful of who you involve in that process and how much weight you really do put on their opinions, because at the end of the day, you're living in that property, not them. So you need to be happy with it and make sure it's the right one for you.
Property is probably one of those things in Australia where everyone's got their own tips and advice on. So if you tell your friends and family, everyone's going to come flocking with their suggestions for you, and they might not always be the right ones or the best ones for you.
I can see Chris nodding his head as well.
Oh, absolutely. It's one of my biggest pet hates, I guess you call it. Family members getting involved and either creating even more anxiety and FOMO. You're not successful till you buy a property, so they can tell their friends and how successful their kids are. I think brothers and sisters, putting pressure on their other brothers and sisters to, follow them, or colleagues or friends, etc., giving them tips. A lot of people act as financial advisors for people without any sort of knowledge on, or real true knowledge on and what worked for them 10, 20 years ago isn't going to necessarily work for you today. And so you've got to be really careful. And also at the moment, you've got to be careful of them all talking you out of it. Can't believe you're buying a property at the moment. That's just crazy. Prices are going to fall. And, people talk you in, and they also talk you out of making a good decision for yourself. So, I think you're right, Emily. We've had clients do that the same. And I actually think that's a good strategy, is to not tell people who you aren't going to really listen to their opinion, or you think is an informed opinion. Because once they say it, you can't then just be like, well, no, I'm still going to do it anyway. You know what I mean? It's because you might say, but I think that's the good move. If you get the right people around you, you just focus on what's right for you. And sometimes that's not buying. It's not always buying. We often tell clients to keep on saving. Maybe get a promotion with work, maybe actually, swap jobs, maybe, wait for that clarity with that new partner. Are you guys going to make it? Do you guys want to, wait 3 or 4 months and then, go in together? Like, there's lots of reasons why you might want to wait. Maybe, you're thinking about a job overseas. Maybe that's going to change everything. So it's not always a case of, maybe you should get your money working more than it's in the bank. Focus on what's right for you and your future.
Most definitely. And just invite them around to the housewarming. That's all you need to do. If you don't want their opinion, just send them an invite and they can come to the party and they can be happy for you.
Yeah.
Once it's all signed and done.
Yeah.
All right. I think it's up to Chris's fourth tip.
Yes, indeed.
Look, I think this is it's probably around the risks after booms in prices that they do increase. The chance of fall increases, the chance of a gain decreases, right? And so we all know that how the markets have moved over the last, 12, not just the last 12 months, even since, mid 2019, really, after the election. So, you've got to be careful right at the moment because people are getting more picky, buyers in terms of what they're willing to compromise on. And they're not got the FOMO they had in the market last year. So they're not willing to pay the same amount of money as they were last year in the height of the boom just to get in for things that are compromised. Okay. So things that are on busy roads, things that are dark, got privacy issues, things that are noisy, things that are, surrounded by other houses or could have development potential, etc. So things that are compromised are at high prices because of the FOMO in the market last year. And a real danger right now is to potentially look at being an opportunist and say, oh, I could get this cheaper than it was last year and not focus on quality. Because as interest rates increase, there's two things that will happen. People's ability to take on more debt will increase, borrowing capacities fall. And secondly, their willingness to take on debt also decreases because they're going, I'm going to have to pay more for the mortgage. And so they're going to become even more picky and less desire to take on big debts for compromised assets. Whereas if a property ticks all the boxes, it's on a great street, it's got great aspect, it's a great place to, live long term. A, there's very few of those because stocks are always really low, those properties. And B, people are like, well, I'm willing to take on this debt, even though interest rates are 3% or even though interest rates are 4%, because I need a family home and I want to live there long term, etc. So you've got to stick to quality right now, just after booms, because if there is a tightening or a global credit crisis or something like that, the compromised properties get smashed. This is what we saw in the 2018 downturn, is they might fall a lot more than the quality assets. So the other question we get is at the moment is, oh, I can't buy that because that's what went up a lot last year. So I'm not going to buy a quality asset. Because they went up so much last year. Well, that's actually the definition of why you should be buying those assets, because they're the things that will hold their value long-term because they're quality and will actually go up the most. So don't go, I can't buy the quality because they're up too expensive. Actually, no, the solution isn't buying a cheap, poor asset. The solution's getting a better quality asset, but maybe you have to shift suburbs now because prices went up.
Yeah, I think that's a really, really good one. And I think it relates perfectly to Emily's final point, the fifth and final point. I'll hand it over to you, Emily, and then I'm sure we'll have a few comments on this.
Yeah, certainly. So the fifth one is around, if it seems cheap, there's probably a reason for it. And it's not so much just, it's on a main road, like, you wouldn't buy on a main road, or blanket ruling these things. It's more around understanding things on a macro level and also micro. So macro would be things such as council planning. It would be any permits that have been issued within the street for construction. It would be larger scale planning that may impact that property. As Australia grows and population grows, there's a lot of areas that are now being targeted for new freeways or tunnels or infrastructure that will actually impact that property down the track. So I think understanding that element, and then on a micro level, the property itself, is it structurally sound? Is it fundamentally functional? Are there aspects that would be better in another suburb if you spent the same amount of money for, a different property? But probably the biggest one around, if it's too cheap, it probably is the notion of underquoting. Now, I know every state has different laws and rules around how they stipulate the indicative price of a property, but certainly in Victoria, the quote ranges are very transparent. Often when you look at them, or certainly from my point of view, I can look at them and go, that's an underquote. And the reason you would know that is if you're in the market constantly and have seen comparable properties and you've done your research. So if you're a buyer out there this year and you're wondering, like, is that too cheap for a reason, or is it an underquote? I would first and foremost do your research on comparable sales in the area that have sold in the last 3 months to see if the numbers stack up on a land, accommodation, and location perspective. If it looks like it's drastically cheaper than everything else, then I would go into investigating a little bit more as to why that might be the case, and just be frank with the agent. Why is it quoted this way? I saw property XYZ sold 3 weeks ago, 200,000 more than this, and it's a similar property. Why is that? don't necessarily trust everything they say, but certainly query them if you've got evidence to suggest that it is lightly quoted.
I can see the benefit of doing that research and asking those questions, because if you keep looking at the quote and then the properties keep selling for much more than the quote, I feel like that would be really disheartening to see throughout your property buying journey.
Yeah, a very common one, the feeling of being disheartened through the process. So that's also being around realistic, which is a good exercise to do regardless of a particular property, is to do your research as to what you can actually afford, because indicative selling price versus actual sale price are two very, very different figures.
So on your real estate app, would you just go through like recent sales rather than things for sale?
Yeah, correct. So you just go to the sold tab on realestate.com or domain and just sort it in sold by date, because sometimes they do by relevance, which is actually, you can blow out to 3 years. Most recently sold, and scroll through them and have a look at the floor plans, the condition and the actual location. Ideally, no more than a 1K radius of the property or area in question for you, and start to ascertain, is this actually achievable for me?
That's a good strategy. Chris, we've got number 5 from you, mate, to round out our 10 for today. What have you got for us?
So I think this is, when times of uncertainty, this is when buffers come in. And so what you really need to do is focusing on how you're structuring everything in your life, insurance, all different things, but around sort of your property decisions. Your buffers really is buying quality, but also structuring your loans the right way. So, understanding your guarantor loans, which we spoke about, understanding how LMI can actually give you a buffer. Yes, there's the cost for it, but you get the benefit of a buffer. Making sure that, you're building money in offset accounts, not just paying down your loans. Maybe you're using interest only if you've got investment properties. You've got to really focus on extending your loan term to 30 years, rather than 25 years will reduce your repayments and give you a bigger buffer. Look at saving hard, to give you those. So it's just all about really focusing on, if something happens to my financial situation, I'm going to be better protected. And so I do think it's a time to be putting those in place now. Then if, for example, there is something going on in the world and you sometimes too late, you can't refinance, you lose your job, or property prices do fall for your property and you can't refinance, or etc. So buffers are so important. Is once, especially after your first property, because what happens is people go from feeling very cash rich, they've worked hard, they've got that savings there, and then they go to sometimes very little in the savings account after. And that is what I call the danger zone. And that is absolutely not a time to go out partying in your new place. Maybe soft drinks at the house party. You might not even have a house party. Never said that before, so it didn't sound very good. But keep it, quite simple in that first 6 to 12 months after you purchase your place. Get that buffer up, and then relax. If you buy a building and a roof needs repair, things like that can really stress you out if you haven't got that buffer. Even in apartment blocks, you can get strata levies increase and all sorts of things. So buffers are so important. I spend a lot of my time trying to educate people on how to build them, and don't be afraid to use them. That's what they're for, is to protect you in downturns. A lot of people think, I can't do that, I'm just going to be stressing about it. Well, no, that gets you through that moment. That's what it was for. So build buffers.
Chris, can I just follow up with one point, which I know it would be like remiss of me if I didn't ask it, which is the people that are coming to you now, like existing clients for Wealthful, are you recommending that they lock in rates, or are they getting fixed rates through you, or what is your current kind of feel of things?
So is a bit of a pendulum that sometimes it's just stay variable. The fixed rates are so unattractive. Let's just go variable. And a lot of the time, that's where the starting point is. Over longer term, it's proven that variable rates will beat fixed rates. Over the last 3 years, probably, fixed rates have just been so attractive compared to the variable rate, because they've been under the variable rate and, sub 2%. At the moment, fixed rates have jumped so much, and they're continuing to jump every day almost. We get a new bank saying they're increasing fixed rates. At the moment, there's still a few banks where you can still get great 2 years and 3 year fixed rates, but it's a few, not most. And, you can get great variable rates in low 2%. And so at the moment, it really depends on your situation, your buffers, and how protected you need to be because sometimes there's a cost of potentially going fixed, that if variable rates don't rise as much as society thinks, and society's been wrong for over a decade, to be honest. And so if variable rates stay low for the next 3 or 4 years, which is a chance, and you could have fixed at a higher rate and paid a higher cost. And so sometimes you should never always fix all your loan as well. You don't have to have 100% fixed or 100% variable. You always split it. So you may go 50% fixed, 50% variable, or 70% fixed, 30% variable. So a lot of people don't understand that as well.
Yeah, it's also a really good point with offset accounts and the like. So, yeah, it's a great conversation to have with your mortgage broker if you haven't already in 2022 or late 2021. Just give them a call and see what they say. Emily, I might just ask one more question for you. Where have you been buying houses recently? Like, what for listeners' sake, where are you? Like, where is your bread and butter suburbs or areas for clients?
Yeah, for sure. So in Melbourne, we are down the Bayside corridor, so pretty much Port Melbourne all the way down to about Mordialloc. And then in the inner southeast pocket, we have a lot of young professionals who commute to the city for work. And then a quadrant sort of out in the north, so Northcote to Reservoir, and then out towards the Glenroy angle as well. So it is a fair bit of ground when you think about it. But the team and I, we love working with the first home buyer market, and that's where a lot of those first homes do fall in those sort of price brackets. So we spend a lot of time on the road, but we certainly enjoy it.
Yeah, wonderful. By the way, we've got all the links in the show notes. So if anyone wants to follow up with Emily or Chris, please do so. Kate, this is a revelation. You sound like you're going to buy a house in 2022. Have you got any questions for Emily or Chris before we let them go? Because this is your time.
I guess just how much work should you probably put in beforehand? I kind of like, when should I start? How much should I do? How certain do I need to be?
I'm a big believer, and I said this to a young client of mine who's she's buying her first place yesterday, and she's exhausted because a lot of buyers are. They've been trying and they've been frustrated, and there's low stock, what Emily was talking about before. But it should be hard, and you can miraculously, this perfect property could come on. It's a quality asset, and you could get the deal done. But that's unlikely. You're more likely to be missing out, trawling, saying no to 95% of the properties. But the thing is, once it's done, it's done. So it's hard to buy. It's easy to sell, because when you get a quality asset, you're getting letterbox drops after about a week from other agents saying, hang on a sec, do you want to sell? Do you want a market appraisal? Because they know if that your property ever comes online, it's easy to sell. So hard to buy, easy to sell. And if something is easy to buy, like Emily says, it's cheap, it will potentially be hard to sell, because the reason it's cheap is the person's struggling to sell it. So they're feeling the pain in the future. You should feel the pain at the start. And so you're doing all the right things, obviously educating yourself on all these things, but it's hard to buy. It's not going to be an enjoyable experience.
Yep.
Yes, you can get help with people like Emily and local specialist buyers agents we're massive fans of, but and they will do it, but it's not like their job's easy. They're doing a lot of the hard yards for you. And so it's a painful experience, but the rewards come many years down the line by actually all that effort.
Delayed gratification here, it sounds like.
Yeah.
Very much so. It's, a lot of buyers do feel deflated in the process, or frustrated. And there's a lot of hours that go into it, but there kind of needs to be, because at the end of the day, it's your home. So yes, there's resources to have assistance, such as a buyer's advocate, but there's only so much they can decide for you, I guess. So the element of the research phase and the inspecting phase and that sort of process has to be done by the buyer. And so even just getting a feel for it as you're starting to think about buying a property and refining down your suburbs and refining down the property type is always good. And probably the more refined, the better in some cases. Yes, there'll be a few options to choose from, but when it comes up, that that's what you've been looking for. And it's actually easier to take action on it than wondering if there's something better out there for you.
Absolutely. I mean, it's all those reference points in your mind that give you the confidence to go for it, right? Because what happens is you've been looking, everyone's nervous, right? Everyone's nervous to taking on a big debt and buying a property. It's a big financial decision. And then even when the right property hits them in the face, they sometimes don't sort of snap it up because they haven't got that confidence. They haven't got all those reference points, haven't seen enough properties, etc. So you do need to get educated, because when that time is to make offers and, go unconditional and to really put your foot down, if you don't at that point, that property goes and then you're back to square one looking again. And so, educating yourself, getting on the ground, looking at lots of properties, always a good idea.
Some great suggestions. Thanks, both of you.
Yeah. We're very, very fortunate, Kate, you and I, we get to speak to the experts like this. So once again, if you're interested, you can hear more from Chris at Wealthful, and Emily. It's emilywallace.com.au, if I'm not mistaken, and also available on Instagram. So Kate, you've got plenty to go on. This is going to be one of our most popular episodes, I think, from a couple of years ago, was the first home buying journey that I went on. Maybe yours is going to come up soon. So as always, Kate, thanks for joining me. Thanks, Chris, and thanks, Emily.
Thank you.
Awesome, guys. Thanks.